Bond prices are still deep in the red, while equity markets are already starting to recover. What's going on here? What can I do as a bond investor? What should I do? The rising interest rate environment of the last 12 months has basically pushed all bond prices deep into the red, no matter how good the quality of the bonds is. This is a more or less fundamental law on financial markets. When the interest rate level on the market for new bonds is rising, which has happened last year because central banks have pushed up the interest rate level. When interest rates are rising, the price of existing bonds is going down, as you see here in the chart. Why is this the case? Take a simple example. Say 1 or 2 years ago you bought a bond, safe government bonds, no default risk. You bought it at 100% and it's offering a fixed interest rate of, let's say, 2%. And that's the crucial point. The interest rate for most bonds is fixed. So you get 2% payout from this bond every year, no matter what. But now the interest rate level on the market has changed. Interest rates have gone up. New bonds, if you now buy from the government a new bond at 100%, it is paying you 4% interest rate, fixed every year. So what do investors do? Well, you can, of course, simply hold your existing bond. It pays you 2% every year. The price will go down in between, which has happened over the last 12 months. But that's the first good thing to know. The price will recover to 100% back again when the bond expires. So from now on, you've now seen the price decrease, and now the price will recover towards end of the bond maturity back to 100%. So over the maturity of the bond, nothing has happened. You bought the bond at 100, you get it back at 100. In between, every year you get a 2% fixed interest payout. But what if you think about selling the bond now? Well, then, of course, question yourself. You can now, today, buy a new bond, 100%, 4% fixed interest rates. Or I buy the old bond from you, which is only offering 2% interest rate. I will not pay 100% for it. That's obvious. How much will I pay? Let's say this old bond is still going on for 5 years. It has 5 years maturity left. So what's the turnout? You get 4% for the new bond, you get 2% for the old bond. So for the next 5 years, you're earning 2% less every year in the old bond compared to the new bond. So 2% less every year for 5 years, the maturity of the bond, 2.5, 10%. I'm willing to buy the old bond from you, but not at 100%, but at 10% less, close to 90%. Which you see in the chart. The price of the bond trading on the market is going down now because new bonds are offering simply higher, more attractive fixed interest payments. So when you want to sell the old bond, you have to accept a price discount. Should you do that? Well, to be honest, it doesn't change a thing. You could now sell your old bond at roughly 90 and then use this money to buy a new bond that pays you 4% fixed interest rates. But you have to buy the new bond at 100. You see the problem? The new bond offers high interest rate payments, but you have to pay it at 100. The old bond offers less interest payments, 2%, but you have to accept 90 for it. And that's exactly the point. The bond market prices all the bonds at the same interest rate from now on for the rest of the maturity, which is to say it doesn't matter for you. You can stay in the old bond, you can sell it and buy the new bond. From now on, you're earning, or the rest of the life of the bond, you're earning the same yield. You're earning roughly this 4% in my example. So what do we take from this? First point, as long as the bond doesn't default, you get exactly the fixed interest rate at the level you bought it 1 year, 2 years ago, and it will be recovered at 100%. So nothing happens. You can just stay in the bond. Second point, it does not pay to switch. If you want to switch, sell your old bond, buy the new bond, you have to accept a price decrease, which exactly offsets the higher interest rate you will be earning in the new bond. So you can just stay in the old bond and that's it. But the best thing, market interest rate levels have now risen. So you can now, with additional money, if you have new money to invest, you can now buy a new bond with 4% interest rate level, or you can also buy the old bond at a huge discount, buy more of it at 90% instead of 100, and also with the old bond, if you buy it at current discounted price levels, you will earn the higher yield for the rest of the life of the bond, the same roughly 4% in my example. So it's a great time actually for new money in the bond market in our view. And what does this all concern bond funds? A bond fund is simply an aggregate of various single bonds. So the same things we just discussed apply also to a bond fund. They came down in price now because the bonds in the fund have decreased in price. They will recover towards 100 at the end of the maturity, and you have much higher entry yield levels now in these bond funds than, let's say, a year ago. So to sum it up, all the best for your investment. Thanks for listening. Don't forget to hit the subscribe button, like us, and see you next time.